In the first quarter of 2021, equity markets continued to rise, with small cap a big outperformer. Small cap stocks underperformed in 2020, and so this year's rise has mostly been a bounce back after last year. The S&P 500 outperformed international indices, and bond prices fell as yields rose. Through most of 2020, technology and online retail stocks saw a spectacular rise. However, we saw a change in sector leadership late in the year. On November 6th, the first vaccine trial data was released, indicating greater than 90% efficacy rates on the Pfizer-BioNTech COVID vaccine candidate. Up to November 6th, energy had declined over 50% as the pandemic caused a worldwide decline in demand for oil. Once the vaccine data was released, energy began to rebound and has since returned over 70%. We saw similar recoveries in travel and retail industries since that time, while pandemic winners have taken a back seat. After several years of rising earnings fueled by the 2018 tax cuts, earnings per share fell 22% in 2020. The decline in earnings and rebound in the equity market has driven the trailing price-to-earnings ratio to over 32 times, above the level seen at the height of the dot-com bubble in 1999. The forward-looking PE ratio is much lower, at 21.8 times, reflecting market expectations for an earnings rebound as the vaccine rolls out and reopening momentum builds. After lagging for most of last year, travel-related activity indicators have begun to rebound, and we expect the momentum to continue into the summer as over half of U.S. adults are now fully vaccinated. In response to the coronavirus pandemic, the U.S. government implemented $5 trillion of fiscal stimulus, and now a subsequent $2 trillion infrastructure spending bill has been proposed. The Federal Reserve expanded its balance sheet by about $4 trillion through asset purchases, injecting monetary stimulus into the economy. This has led to a greater than 25% jump in money supply growth, the highest year-over-year increase on record. The big question on everyone's mind is, are we overdoing the monetary stimulus, which could lead to inflation? One historical example of hyperinflation occurred in Germany in the early 1920s. After World War I, Germany began printing money to cover war costs, resulting in a 100 billion% increase in money supply. This year's 25% jump in U.S. money supply pales in comparison. A more recent example of inflation occurred in the U.S. during the 1970s and 80s. Oil prices spiked sharply, leading to 10 to 15% annual inflation. Since that time, the economy has become less dependent on oil, and the U.S. has seen a 30-year downtrend in inflation as productivity has increased with technological innovation. The Federal Reserve has signaled that it will keep its benchmark target rate at zero until at least 2024. The Fed is willing to let prices run higher after struggling to see any inflation over the last decade. Housing is the largest component of CPI, which is the broadest measure of inflation. This is measured not by the housing market, but by rent prices, which declined precipitously in 2020. When the pandemic hit last year, 20 million people lost their jobs, and most of them were hourly workers in service industries, those who were not able to work remotely. Many of those workers tend to rent their homes, which is why we'll need to see those jobs return in order to see upward pressure on the housing component of inflation. Though the labor market has partially recovered, we're still down about 8 million jobs relative to pre-pandemic levels. The U.S. economy, as measured by gross domestic product, or GDP, fell sharply in 2020 and has not yet recovered. However, given that 2/3 of GDP is consumption, if the expected pent-up demand from consumers comes to pass this year, we could see a larger than expected GDP growth reading. This could stoke further discussion of higher inflation. We have begun to see some inflationary pressures already. Oil prices have rebounded in recent months as the reopening momentum has begun to spread through the economy. The rise has not been as dramatic as the shocks experienced in the 1970s and 80s, but prices have marched higher alongside increased demand. We've also seen raw materials prices increase, particularly lumber and copper prices, on higher demand for home remodels and home building. Shipping costs have also spiked as the pandemic has shifted spending from services and experiences to goods. The Suez Canal blockage, a global shipping container shortage, and general shipping delays have exacerbated the issues. As inflation discussion has picked up, the yield on 10-year treasuries has increased from about 0.9% at the beginning of the year to 1.65%. Though this is still below the 2.5% level seen in 2019, a 0.75% increase in 3 months is a sharp rise. We think rates could move higher as inflationary pressures build, with the injection of stimulus, increasing raw materials prices, and the potential for a large GDP growth surprise. Although we do not foresee a hyperinflation scenario like that of 1920s Germany or an oil price shock scenario like the US experienced in the 1970s and 80s, we think we could be headed towards somewhere on the inflation spectrum.